Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
All right. Hey, Value Builder community. Today, I'm talking to Danny Gould. He is a CEO of Gould Capital. He is on the other side of the coast. He is in Silicon Valley, has amazing story. He started as a med graduate from Stanford, and then he dived in residential real estate, and then he transitioned to hotels, value-added hotels, which is very, very interesting transition. I would like to dive into that story. And also I'll be asking about how does the value add looks like in hotels. And so I can get this understanding what's typical value add in hotels and how does he underwrites those deals. We're going to dive in maybe one or two deals. And yeah, by the end of this podcast, you will get a sense, how to look for deals in hotel space. So Danny, so if you can start, just give us 2 minutes introduction about yourself or how you started from Stanford all the way to buying hotels.
Yeah.
I know that's really, really interesting transition.
Yeah, it definitely is interesting, and I'll try and keep it brief so that we can get to the good stuff. Basically, my main vision has always been to build a hotel in Las Vegas, and that's been my North Star since I basically graduated Stanford. And every decision that I've made up until this point has been what is the most optimal way to kind of get to where I want to go. And it sounds weird that like residential real estate would be the natural path there, but right now, when I was just graduating, it seemed like the next best move. And since then, I've just continued to make what I feel is the next best move to get me to where I want to go. But ultimately, every decision and going and working with Sujay JD, with my time, with my hotel partners, and now with Gould Capital, every decision that I've made up until this point has been the decision that I think is best to get me to ultimately build a hotel in Vegas.
That's awesome. Yeah, I've seen that you talking about it. This is amazing. So look, hotels value add. I'm in industrial real estate, and I don't know many people who are focusing on that. You definitely the first one who I was able to meet. If I would ask the question, let's say, if you're looking at a hotel deal, what is that kind of napkin calculation when you're screening the deals? What are the main components you want to push the lever to increase the value of the hotel? I understand the occupancy and stuff like that, but probably there is some other intricacies there. Let's say I'll give you an example on if it's industrial deal, just like first of all, you look at what are the market rents are per foot. And let's say if it's a $9 a foot, then it means I can buy this probably deal all in at up to $90, meaning my buy price 60 plus $30 I spend, that I kind of, understand that is going to be there to dive deeper. With the apartments are different per door. What are those levers in hotels, if there are any?
Yeah, just like any business, Saul, there's two main ways to increase your bottom line, and that's either to increase top line or decrease expenses, right? And so when you're adding value to a hotel, obviously the first thing you want to look at are the financials and figure out, what are the ways in which we can drive top line revenue or decrease our expense margin. On top of that, there's many other ways, but every way that we use in the hotel world to create value and to add value will inherently affect one or both of those things, either top line revenue or expense margin. So let's start at the top, right? Let's just do top line revenue. So how are ways that we can increase top line revenue? Well, first of all, the easy one is like you said, increase occupancy or increase the rate, right? And so typically when you're buying a hotel, you're going to be given what's called a star report. The star report is the way in which hoteliers gauge their hotel's performance and the health of their hotel versus other hotels in what's called the competitive set. So in other ways, you're comping out the hotel versus other hotels in a very close radius to yours that are similar, meaning if it's a limited service hotel, it'd be other limited service hotels within a mile or two radius of the hotel to see how those hotels are performing. So most brands report to Smith Travel Research, which is short for STAR, or STAR is short for Smith Travel Research. When you buy an asset, or when we're assessing an asset, we would look at the star report to see, okay, well, how is this hotel performing right now relative to the comp set? Is it underperforming in terms of occupancy and ADR and RevPAR, or is it overperforming? So typically, a hotel is going to have an opportunity. You're going to have an opportunity to add value to a hotel if the hotel is underperforming the comp set in some way. Meaning, if it's under.
Now, do you mind if I ask you just, okay, so when you're looking at this comp set, so in those comp set, you're looking at comparing occupancy and rent rates, or what are the components when you're either comparing sale price or rent price, but in hotels you're comparing occupancy and room rate. What are the in that comp set typically you look at?
Great question. So there's three main. There's a lot of things that are included in the star report. There are three main metrics that you look at in a star report. The first one is occupancy, and that's measured as a percentage. And that's typically measured as a percentage on a week to week basis, month over month basis, and a year over year basis. Okay. Second is going to be ADR, average daily rate, right? So what is the average daily rate that you're getting per room, right? Then you have revenue per available room, which is RevPAR. And RevPAR is simply occupancy rate times ADR, right? So when you take the ADR, which is the average daily rate, and then you multiply that times the occupancy, then you're getting the revenue that you're achieving per available room, right?
Available room, yeah.
Right. You're following me so far?
Follow, yeah.
Perfect. So if the hotel is underperforming the comp set, right, then that means that there's room to grow. The market is showing you that there's room for that hotel to grow. Okay. Well, sure. However, there might be some other factors there that are inhibiting the hotel. So is it just poor marketing? Well, sometimes it could be, right? Sometimes it's just poor marketing, and better marketing would result in more heads and beds, or ability to charge more money per room. And that alone could get you to where the comp set is. But a lot of times there's more to it than that. Number one is how renovated is the hotel, right? So when you think about value add, you think about renovations. Well, ultimately renovations drive top line revenue, right? So a brand new renovated hotel is going to achieve a higher average daily rate than a hotel that hasn't been renovated in 20 years, right? The pictures will tell the travelers, tell the guests all they need to know, right? So that's number one. Number two is brand. So if I own a Marriott hotel and there's a couple, and by the way, all the brands are great. I'm not here taking shots. I'm telling it how it is. If I own a Marriott and there's a Best Western, a Wyndham, a Hilton, and a Choice hotel in my comp set, I should be the top of the comp set because I'm a Marriott and I have the best reservation system. But if I'm a Wyndham, right, or if I'm a Best Western in a comp set with like 4 Marriotts and a Hilton and maybe a Choice hotel, well, then all of a sudden, if I'm at like 90 or 95% of the comp set, I'm actually doing pretty well because the brand is not as strong. So another way to increase value, Saul, is to upgrade the flag.
Upgrade the flag, right? Yeah, that was a follow-up question. Where do you stand about independent and boutique hotels and trying to say that 5%, franchise fee and going boutique route? But I don't know if we want to go to that tangent, but I think you answered the question. One of the ways actually is best ways to go in the better flag.
Yeah. So, and by the way, like a lot of it, this is all hypothetical. There's a lot of hotels where like, if this hotel is 30 years old, 40 years old, unless it's like in a tier 1 market, there aren't many like top tier brands that are going to accept an older box like that into their reservation system. And so you have to pick the best. It's a flag the market match. You want to pick the best brand for hotel. And by the way, Marriott might not be the best brand for your hotel, right? But it's the best brand period right now because it has the greatest brand contribution right now as a whole. So the Marriott reservation system Bonvoy is the best one right now. Hilton Honors number 2, and then so on and so forth. Everyone argues about who's number 3, but it's very obvious and clear who's number 1 and number 2 in the space.
So do you mind, let's say on Marriott, what's the general rule of thumb? Let's say, if I have a hotel, I'm able to get a Marriott brand.
Yeah.
What percentage of reservations normally, generally, I should expect from them to come back instead of me booking everything?
That is 1000% dependent on the location of the hotel. I mean,
Okay.
that is not a one size fits all.
Mhm.
It's not a one size fits all answer, but I mean, look, like there are many hotels where you'll see brand contribution exceed 50% of their total bookings, right? So, and that's not uncommon, right? But I don't know that you'd see that. You wouldn't see nearly as high of a number for like a Wyndham asset or like a Choice hotel.
Makes sense. Makes sense. All right. So we're still, yeah, talking about top line increase. Was brand, comp set, anything else you focusing right from the get go?
Yeah, again, I think we kinda nailed all of the different, like, major contributors to top line revenue growth, which
Mm-hmm.
would be a better marketing, newer hotel, and brand alignment with the market that you're in.
Mm-hmm.
In terms of expense control and its expense
Mm-hmm.
ratios in particular, that is generally management. So,
Mm-hmm.
from an operator's perspective, there are and by the way, there's a lot of great operators out there. There
Mm-hmm.
are many operators who are more cost conscious and just have a better ability to control expenses.
Mm-hmm.
And those are the operators that really know how to squeeze the lemon and get all the juice out of it. Every hotel and every brand and every market is different. Like I could own a
Mm-hmm.
courtyard in New Mexico and I could
Mm-hmm.
own a courtyard in Manhattan. The courtyard in Manhattan might do a 10 to 15% margin or EBITDA after replacement reserve, while the courtyard in New Mexico does a 40 to 50% margin.
You're talking about OPEX expense off the top line, right?
Why? Right? So for
Mm-hmm.
ease, for everyone to understand, right? So
Mm-hmm.
NOI, 10 to 15% in New York City, but like 40 to 50% in New Mexico.
Mm-hmm.
So expense ratios are relative to the market that you're in because every market's going to have different cost of labor and cost of goods. And those are really the two main components of your expense ratios, but how you control those is going to dictate how successful you are as an operator. So if as an operator you go into a market and you know like, hey, I have other assets in this marketplace where I'm delivering a 35% margin NOI, right? After all expenses, after replacement reserve and everything, I'm delivering 35%, and this hotel is getting 20% right now. Well, I know that I should be able to squeeze an extra 15% out of this asset, right? And for every $1,000,000, for like on a property that's generating, say, $10,000,000 a year annually, that's $1.5 million extra to the bottom line every single year that I could pull out that this current operator isn't pulling out. And so that's how you assess whether or not operationally you're going to be more efficient and whether you're going to be able to add value through operational overhaul in the hotel. Make sense?
Makes sense, yeah. Now, so question leading to that, in your industry in hotels, is there efficiencies? Does efficiency improves when you go up the chain to the bigger and bigger operators? And for example, let's say, I remember in self storage, there was efficiencies going to a certain scale, going in house with everything in house. But then let's say, extra space where you have so much efficiency like nationwide, they were just way more efficient than any even small regional operators, in my opinion. So that was kind of great. As you move up chain, you improve efficiencies. But it's not in every asset class. No, I'm just curious. In hotels, do you think that the most effective operators were they operate in house most of the stuff and with a smaller portfolios? And do like large institutional brands, they actually squeeze that efficiency? Where do you see that?
Okay, so I don't like to make broad overarching statements, but I'll
Mm-hmm.
I'll share with you some observations that I've
Mm-hmm.
made in my time. So, generally speaking, the operators that I've seen who are the most efficient, meaning are able to drive the most money to the bottom line, are
Mm-hmm.
typically your middle market managers that are
Mm-hmm.
still self-managing a lot of their properties or are vertically,
Mm-hmm.
right?
Yeah.
So vertically integrated, maybe 10 to 25 hotels max that they have in their
Mm-hmm.
portfolio. Once you exceed that, then there's the law of diminishing returns, right? So
Mm-hmm.
for operational oversight, it's just like anything else, right? Like
Yeah.
eventually you have to outsource, you have to delegate, and larger management companies, third-party management companies that manage, dozens, hundreds of hotels even, they typically have a reputation for not having as keen of an eye
Mm-hmm.
on the assets, and that's both from a top line, but especially from an expense control
Mm-hmm.
um, perspective. When we go into a hotel and we know that it's being managed by a certain cohort of management companies who are like larger in the world, we know right away that we're going to be able to manage it better than them. And by better, I mean we're going to be able to manage it in a way where we pay closer attention and are able to drive higher margin because of the oversight that we have on the asset versus larger managers tend to not need. I mean, let's face it, right? Like a lot of these management companies are managing for larger REITs and larger funds that are happy clipping like an 8% coupon every year. And so
Mm-hmm.
when you're happy clipping an 8% annual coupon to your investors every year and then you keep every penny over that, suddenly, the need to drive a 30-40% margin is inconsequential. It's unnecessary. And so it's the economies of scale that kind of grant you the luxury of not having as keen of an eye.
Makes sense. Makes sense. Now you mentioned about EBITDA. So this is, the question on another aspect. The valuations of hotels. Do we value them as an NOI and cap rate perspective? Like in, call it industrial, it's a 7 to 9 cap, and you divide the net operating income, or are they valued by the EBITDA and times 3, times 5, depending on how much EBITDA we have? How do you value the hotel?
Yeah, so, and this is where it gets confusing for a lot of people
Hmm.
because truthfully, EBITDA and NOI are the same thing.
Okay.
In the hotel space, what one would say is NOI in multifamily or in industrial is the equivalent of EBITDA post replacement reserve in the hotel space. So
Okay.
you can use them interchangeably. We use
Hmm.
EBITDA post replacement reserve. That's just after replacement reserve.
Hmm.
That's how we talk in the hotel world. But you can very easily replace it with NOI. It's very interchangeable.
Hmm.
And how these hotels are valued is very interesting. There's the back of napkin way, which is revenue multiplier. This is how like a lot of old school hotel guys will value hotels based off of revenue multiplier. And so they'll say like, hey, whatever this hotel is doing revenue wise per year, let's say it's doing 5 million in revenue. Well, this hotel's worth 4x rev, so it's worth 20 million.
Yeah. So value like that. When you say revenue, it's not a top line. It's
Yes.
it's bottom line post reserves, right?
No, revenue.
No,
Revenue
top
means
line,
one revenue. Yes.
top line.
Yeah, exactly. Again, this is old school way of doing it, right, bro? So I'm
Yeah.
telling you, like, this is old school way. Uh, Rates are still very much a thing in the hospitality sector. So you would take your NOI, right, post replacement reserve, your EBITDA post replacement reserve, and you would, you'd assign a cap rate to it, right? Divided by the cap rate, and there's your valuation. And there's a lot of other ways. Like there's a cost per,
Hmm.
price per key. So like a lot of hotels are valued in a price per key. So, hey, we know in this market, these are the comps, and the average hotel is selling at $350 a key, and or door, in multifamily, but in the hotel world it's keys, right? Um, 350K per key is the value of the is the comparable value, and so that's how, because again, right, like you've got every hotel on the block is going to have a different key count, is going to have a different door count, right? So that's another way that is used to kind of value hotels. So I would say those are like the three ways that you kind of like look at hotel valuations are going to be on a revenue multiplier basis, a cap rate basis, or a price per key basis.
Makes sense. Is there a range, for example, if you're selling on a cap, West Coast, major market? Is there a range that you see the guys selling them still at 6 to 7 or 5 to 8? No, what's the range of the cap rate if you're selling them right now?
It's such a wide range, and it has so much to do with the market and the flag, right?
Hmm.
Market and flag are the two biggest determinants of cap rate that the properties will trade at. I don't think right now, like let's say tier one city, top tier flag, you know,
Hmm.
6 to 8 caps
Hmm.
typically on a Marriott or Hilton branded asset in a tier one market. Maybe a little bit below that if you have a really strong flag in a really strong city and it's brand new, whatever. But then, the middle tier flags are usually trading at like 8 to 12 caps,
Hmm.
in tier two cities. And then the more boutique-y kind of stuff, usually trading at like a 12 to 15. 12 to 15 and like the lower tier flags, like 12 to 15 caps, right? So it's
Makes sense. Makes sense.
wide range.
Yeah. Yeah. That's animal by itself, and it sounds like it's more as a business, not a real estate play. If you just to the when I'm listening, if there is a such a wide range of the cap, plus there is such a wide range of the expense ratio. You mentioned 10 to 40%. Um, it really sounds a little bit more business than a real estate. Would you agree to
Oh,
that or
I
no?
100% agree with you. And this
Right?
is the thing that makes hotels unique. And
Mm-hmm.
it's the reason why, first of all, I love hotels because it
Yeah.
mixes the two things that I love the most in life, which are real estate and business. Right? Those are my
Mm-hmm.
my my two biggest passions are real estate and business, and it's like the perfect baby between the two.
Yeah.
So that's number one. But number two, it also means that the room for error is lower and the room for volatility is much greater,
We're greater. Yeah.
right? So you
Exactly.
could take a $100 million hotel and make it worth $10 million in a year. Not really, right? Because the real
Mm-hmm.
estate still has so the real estate there is your foundation,
Yeah.
right? But here's the thing, Saul, if you can't get that hotel to perform at a level that makes sense for that hotel in that market, then it's just dead weight because ultimately that structure, unless you're converting it into condos, really can't be used for anything else. Right. And so real estate it's almost land value because the building almost doesn't have value if the business isn't performing because it's such a specific box and such a specific build out that a lot of developers have found out the hard way that to convert a hotel to condos sometimes it would be cheaper to build them from scratch than to renovate an
Yeah.
existing building into condominiums, right? So and that's not universally true. There's a lot of projects that have been successful in hotel to multi conversion, but it can be difficult. So anyways, not to get too far off track, but
Yeah, totally makes it. The way I see this right now is, I think controlling expenses is similar to real estate, but I think top line is more uncapped compared to called apartments or industrial. If the price per square foot is $8, I mean you may be gonna push it to 8.5 with mm, some really aggressive broker or some additional amenities, but you can't double that. It just won't happen. In hotels, I think, you take one brand and you do a massive renovation with additional amenities and maybe some additional revenue generation. I don't know, events space, and I'm just thinking you probably can double revenue, even though there is other hotels that are, charging half of that. I don't see this as kind of happening in industrial world. There is very commoditized pricing, and I
100%.
think in hotels you definitely there is way more innovation to push the top line.
100%, 100%. Like I said, that's the beautiful thing about the hospitality sector is that from a value add perspective, think about all the ways that I just described to you in which you could add value. I would argue that
Yeah.
if you look at any other asset class and you talk to operators in most other asset classes, their list would be 20 a tenth of what the list is in terms of how you can
Yes.
drive value in a hotel. So that means there's a lot more room for growth, a lot more room for error though, right? So that's why operations are so crucial in hotels and why very few people actually get into it. I know a lot of groups, a lot of investment groups that will specifically say we invest in everything except hospitality. Why? Because
It's
it's
hard.
hard to understand. And a lot of people don't understand it. But they understand this, that they shouldn't invest in something that they don't understand.
Exactly. Yeah. That's so true. Awesome. Yeah, that's great. Now, do you mind touching base on renovations? I don't know how you involved in renovations. And are there any like rule of thumbs in the West Coast, for example, in Midwest, for industrial properties? You know, if it's a light renovation for me, it's like $10 a foot. If we're doing, mechanicals and a little heavier lift, it's 30, $40 a foot. Is there any like rule of thumbs in terms of renovations? How much you're spending per key? You know, let's say light lift, major lift. What are you guys spending over there?
Great question, man. Great question. No one's ever asked me that before. Light PIP. So in the hotel world, it's called the PIP, property improvement.
Pip.
Uh,
Okay.
a lot of people are used to hearing PIP and they get scared because it's performance improvement
Yeah.
plan, right, at work. So PIP, property improvement plan. So the PIPs are usually brand mandated. So these are brand mandated renovations that need to happen after a certain period of time or during the change of ownership. So typically, whenever a hotel changes hands, they're going to require that some of these brand mandated changes and renovations get done. So on the low
Mm-hmm.
end, on the low end, K a key, right, is like a
Mm-hmm.
really low, 5 to 10,000 a key is going to be like a light lift. So think about it on a 100 key property, that's like half a million to $1 million.
$1 million.
Not
Mm-hmm.
much, right?
Not much. Yeah.
Then the next, and by the way, that would that's on a per key basis, but that price is includes, I should say, any renovations or modifications that need to be made to the common area as well. But it just gives
Common area as well.
price per key, even though
Mm-hmm.
it also is reflective of the total dollar amount necessary
Mm-hmm.
to renovate the whole building. 10 to 25 a key is gonna be like a moderate lift, and then
Mm-hmm.
25 to, say, 50 is gonna be a heavy lift. Anything above 50 is usually a complete change in flag. So you're usually
Mm-hmm.
changing the brand at that point, and which means that the common areas are gonna be completely gutted and changed, and then there's probably gonna be a bunch of new carpet and furniture, and the showers are probably getting ripped out. I mean, it's a full gut, right,
Mm-hmm.
of each room. And that I don't know that I've ever seen anything like more than 60 to 65 a key on something like,
Mm-hmm.
but like it could get there. But that's a massive lift. Like if I'm underwriting a hotel that's a value add project, I will typically assume it's going to be 50 a key
Mm-hmm.
if it's like a major lift. Because that's usually the top end of what you'll see.
Mm-hmm.
Anything more than that's, like, excessive, and
Makes sense.
it needs to be justified in some way.
Now, how is lending market right now post COVID in hotels? Did it recover or it's still tight on the credit?
Last 6 months or so, things have really starting to soften up a bit, loosen up a bit. 23 and 24 were pretty brutal, but this year seems to be getting more loose as time goes on.
Mm-hmm.
And loose is relative, right? Because it's still not back to where it was before, but I would say that it's we're getting there.
What is the typical LTVs on construction bridge loans? In my world, it's 70-30, 75-25 typical in equity side. What do you see in a hotel?
Yeah, I would say I would say 65 to 75 is like the typical
Mm-hmm.
that we'll see on a total LTC, right?
Mm-hmm.
Loan to cost,
So similar.
that includes the PIP, right?
Yeah.
And then yeah, so we're looking, and there are some lenders that I work with that'll do stretch seniors from 80 to 85%. Obviously, like if there's gonna be that much leverage, then the sponsor's got to have a really strong balance sheet. There's gotta be a story there. There's gotta be a clear path to take out in, 24-ish months or so. But, yeah, typically, we're seeing 65 to 75 LTC.
Makes sense. Now, I want to pivot right now on where do you buy in terms of hotels. I came across few. I can remember one we bought Piqua Mall, entire mall. It was carved out hotel to someone else. A Patel family bought it. We had no idea how to operate that thing, so we just we bought them all. But that was in Ohio. Where do you buy? What territories do you buy
Yeah,
or you source?
and to clarify here, right, Saul, so right now, my core business model is in helping sponsors raise institutional capital for
Mm-hmm.
their projects, right? So Gould Capital, previously with my previous group, I was a co-managing partner of a small hotel portfolio in Ohio. And then last year I branched off and started my own investment office. And in my time with my previous group, I built a large Rolodex of institutional capital partners and realized I could be raising for a lot more groups than just the group that I was with. And so decided to start Gould Capital. And what we do is we help sponsors source larger check writers for their deals. So typically the minimum deal size that we'll look at is like 20 to 25 mil. Sometimes I'll look at
Hmm.
smaller stuff, but like typically 20, 25 mil total project size is kind of like where we start and we go up from there. So right now, like that's like where my main focus is. I'm not necessarily looking at hotels to buy on a daily basis right now, like I was say a couple of years ago when I was with my previous group. But I would say that in terms of where we work right now and where Gould Capital
Hmm.
works, have projects all over the US from the East Coast to the West Coast. I haven't worked in anything in Alaska or Hawaii yet, but
Hmm.
a lot of the 50 state or a lot of the 48 continental states, then I have worked on in the past. So yeah, I don't know if that helps clarify.
Yeah.
Yeah.
Yeah, for sure. No, so definitely, I just want to shout out. So anyone who is listening and who has a hotel on a contract and need to raise capital, I think you would be a good person to reach out, right? No, as long as it hits the threshold, $25 million and up, where people can find you.
Yeah, thanks, Saul. And I would even go so far as to say as right now, obviously because my background is in hotels and hospitality, it's about 80% of my deal flow comes from the hotel sector. But a lot of my partners and a lot of my capital relationships do deals outside of the hospitality space.
Hmm.
Right now, I've got a couple of industrial buildings, actually flex industrial, a medical office, a couple multifamily that I'm raising for as well, in addition to value add and ground up hospitality projects. So I would just say that if anyone has a project that they need help raising money for and they're looking for larger slugs, because anything less than a $5 million equity check is really hard to raise from institutional groups.
Hmm.
You got to go more retail route at that point. But beyond the $5 to $10 million equity amount, that's where someone like myself can come in and actually bring some value and help introduce you to the right capital partners. So if you've got a deal for that you want us to look at and you have a track record, right? So first time
Hmm.
sponsors are really hard for me to work with just because of the requirements and the mandates of these individual groups. But if you've got a track record and you have an asset that you're mid acquisition or you're looking at it or it's a development deal, whatever, then feel free to reach out. I would love to chat with you. You can reach me at dgould, it's DGOULD at gouldcapitalinc.com. It's GOULD capital CAPITAL Inc.com. And hopefully you can put that in the show notes so people don't have to write it.
So for the folks who want to reach out to Danny,
Yeah.
they can reach out. I think I would like probably to do another episode with you talk about institutional capital structures, because myself and I think most of the audience, I would say probably it is $5 to $10 million range deals, and most investors of mine are retail investors,
Yeah.
or but I haven't worked with the institutional. Even though we had conversations, but we never penciled out to it. But so I would love to do maybe at some point another call, so where we can kind of compare retail rates and institutional structures, which I believe will be a little different.
Yeah, oh, I would love to, man. And by the way, like even though maybe the majority of your audience isn't kind of in that bucket or in that world or whatever, there's a lot of crossover there just in terms of principles that you can apply
Hmm.
to your own investment strategy. I mean, look, these guys manage hundreds of millions of dollars, sometimes billions,
Yeah.
right? These are large funds and family offices, and they look at things differently. And once you start to understand how they look at it, trust me, it influences how you look at deals too. And so in a lot of ways, I've become a better investor just by socializing with these groups and understanding how they look at deals. And once you really start to understand the frameworks that they use, I believe that there's a lot of value in that, and a lot of people could apply some of those principles, not all of them, right, but some of those principles to their own investment decision making. So yeah, happy to make another podcast and chat with you some more about that.
That's awesome. Yeah. So maybe, by that time I'll be able to send you a deal on that size. Maybe we can start cutting it up
Let's do it.
while on the
Love it, man.
podcast, at least how it is going to look like with institutional level cap.
Yeah, man. No, I absolutely would love to. Actually, it's funny, like some of the deals that I'm raising for right now are either previous podcast guests of mine or people's or sponsors whose show I was on, kind of like you, right? So it's just a great way to build a relationship and happy to look at your deals too. That'd be awesome.
That's awesome. All right, Danny, I really appreciate for your time. It was a ton of value. Anyone wants to reach out, I'll post in the comments Danny's contacts. And thank you very much. And we'll talk soon next time about other deal with institutional capital.
Sounds great, Saul. Yeah, and kudos to you, man. We want, you're like, hey, we got to get to the meat and we got to get to the value on this one, and so you stayed true to it. Value builder. We covered a lot today, so
Appreciate it.
excited that we were able to get through so much.
Awesome. Thanks, man. Thank you.
You've been listening to the Value Builder podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.